Welcome once again. We were doing national income accounting, measurement of national income accounting, in which we were doing three methods. We've done value added method, income method, and expenditure method. Today I have brought up a numerical based on, say, income method and expenditure method. So in this class, we'll try to do this because generally we find that in the exam they give you the variables and their values from which you have to find out the national income or any other aggregate. It can be gross domestic product at factor cost or net domestic product at market price, whatever. Based on the they'll give you a numerical, or based on that you got to find out. So here I've taken a numerical from an NCERT book. So here it is. The values are given. So the values are, in this what we have to do is calculate. And one more thing, just remember that when you get a numerical like this, both will match. Like if you solve, or the solution is with the help of income method, it will match with what the expenditure method shows. The reason is simply because they give the same, that means, for example, the income that is received is going to be spent. So whatever the income has been received in this numerical will be spent as expenditure. So both the values should be the same, rather are the same. So in this numerical, you see the values have been given and the items are there, or the variables are there. Like first is compensation of employees, then you have government final consumption expenditure. So you feel, okay, compensation of employees is somewhere, it's for the income, and that variable is connected to income. And if you're talking about government final consumption expenditure, it is connected to expenditure method. So as you read, you will, in your mind, you keep on jotting down what has to be placed where. So that is important, and in that way you will work out a formula. For income method, you will work out a formula for expenditure method. So you got to work out two formulae based on this information. So let's read the information. So third is indirect tax, D is gross fixed capital formation, E is mixed income of the self-employed, F is interest, rent and profit, which is also known as operating surplus. Then you have change in stock, G, H is export of goods and services, I is import of goods and services. So you know we have to take up net exports, and that comes in expenditure method. So you will be careful about finding out export minus imports, net exports. Then you have this J, private final consumption expenditure. Then you had net factor income from abroad given, and then you have subsidies, and then you have consumption of fixed capital. Now the question is that we have to find out gross domestic product at market price. So in this we are not going to use net factor income from abroad. Alright, so now let's do it with the help of income method. So look at this. I've shown you, for writing all this, for writing the formula itself, you get 1 mark. For example, now let's take up the income method. So in income method, A is what? Compensation of employees. And what is F? Operating surplus, that is rent, interest and profit. And what is E? Mixed income of the self-employed. If you add up these three, what do you get? You get net domestic product at factor cost. So in this, what you have to do is you have to add up consumption of fixed capital, that is depreciation, to get gross. So M, gross. So for that you will add up depreciation, and you will, now what you get in net, if you add up depreciation, what you get is gross domestic product at factor cost. And from now, what have we to find out again? we have to find out gross domestic product at market price. So now the aggregate that we have been able to get solve is gross domestic product at factor cost. In this, what we will do is we will add up net indirect tax. So we will try to we will solve indirect tax, which is C, and then we will take subsidies. We have to minus subsidies from here. Okay, so that is L. So C minus L, and then what you get is GDP MP. So this is how you will solve this. Is that clear? All right, now then we come to what is known as, let's take the expenditure method. How are we going to find out how are we going to solve and get that aggregate of GDP MP with the help of expenditure method? And for writing the formula that you will build up, that'll give you 1 mark. So this is a 6 marks question, 3 marks for income. So if you've just written how to go about it, like for example, if you've been able to just write this will show us that you know exactly what to do, and with this you will get what is known as 1 mark. So even if you make some mistakes here and there, it's okay, but then we know exactly that the concept is crystal clear in your head. So in the same manner, now let's do the expenditure method. We are going to solve the expenditure method. So even in this is straight away, you know, C plus I plus G plus X minus M gives you the expenditure method. So you don't have much to do. In this, let's take, first what is that? First let us take what? Private final consumption expenditure. Come on, let's find out in these variables or in these items, where do you find that? Yes, you got it, it's J. So J is private final consumption expenditure. And then which is the next one? Government final consumption expenditure, that is B. Now plus, what do you have to get? Investment or gross domestic capital formation. But they haven't given you that. They've given you gross domestic fixed capital formation and change in stocks. So look for that. So okay, D, you find gross fixed capital formation, and you have, and let's find out where is this change in stocks. Have they given? Yes, G is change in stocks. So once you add that up, you get gross domestic capital formation or investment, and then you want to find out what is net exports. So plus net exports. So H, you got 8, and 8, what do you have? Export of goods and services. I is imports of goods and services, the difference. So when you work out the difference and you then finally add, what you get, what is known as GDP MP, and you get the answer, right? So this is how to go about it. I hope you've understood. This is the basic, and the more you practice, the better you will get. And into this, like for example, you get 40,263 rupees crore, and in this, if you added up what is known as net factor income from abroad, which is given, so that was minus 284. If you did that, if you minus that term, plus minus, it becomes minus, then what do you get? You get you would have got GNPMP. All right, so this is how you juggle around, play with these. This is, again, let me remind you, this is nothing but theory. So if you know your concept and theory well, you'll be able to do any numerical.